Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we're actually going to discuss a buyer's perspective and risk factors in business valuations with Al Danto. He has over 30 years of experience with startup companies, entrepreneurial companies, as well as expertise in the acquisition, valuation, and divestiture of business interests. He has served as a representative for a multitude of engagements. He has experience working with lenders, private equity groups, and individual purchasers or buyers. And he served on a variety of boards, including the alumni board of the Graduate School of Business at Rice University. He is also a full-time professor at Rice University, and he's a member of the NACVA, which I am also a member of. So welcome, Al.
This is where I think really captures it. So if I ask you, what's the average between 1 and 99? It's 50, right? So if you say, well, and this is what I get more than anything else in the real world from a CPA who advises a business seller, from maybe a valuation person that comes in there that'll run these multiples, right, or run these averages and do this. But I kind of have a background from undergraduate and through college. But if you look at averages, it's like, what's the standard deviation? How wide is the norm? Where do we go, right? And if you look at a business and let's say that the average in the industry was four times, well, all that means is half was below and half were above. So companies in the exact same industry with the exact same earnings have completely different valuations based on their history and based on their risk. And in my classroom at Rice, I take two flower shops, Linda's Flower Shop, $1 million in revenue, $200,000 in EBITDA, but completely different risk profiles. One's in Austin, no customer concentration, the business is growing, they have a recurring program for birthdays and anniversaries, solid. And the other is in Detroit, Michigan, where I'm from. I'm from Detroit. I moved down to Houston as quickly as I could after college. But but they had Ford Motor Company, customer concentration, they had no internet present, they had bad reviews, which is a huge driver of valuation now, poor online reviews. Very hard to change those. But these 4.5, 5-star reviews can really add to valuation, right? All these components. So but all we're talking about with average is this middle point, right? Just means that half are left and half are right. So the job of the business valuator is to come in there and say, where along this bell curve should this company fall? And that's based on the company specific risk that you're looking at, right? What are the risks that are embedded within this company, or maybe the industry, or maybe the area, right? That they're at. But business owners, especially when they start thinking about having an exit, selling, have to really be cognizant of this. So what does it take to move a company, above average? Right.
Well, and even if in this example, if you had two companies that even had similar cash flow and operation, it could be different locations, but if they had like generally the same cash flow, but one has a horrible reputation and one has a good one, I mean, I think everybody in the audience would agree, like they don't have the same value. Like, I don't want the cash flow coming from the trash can. I want the cash flow coming from, the somewhere nicer kind of
exactly.
Yeah.
But it's hard to break that conception, right? Because the CPA or somebody who says, hey, this is what the other company sold for. They say, hey, I've called everyone in my industry, and this is what they're selling for, right?
Here's a rule of thumb, right?
Yeah.
Yeah.